a service provided only for the well-off people, rich people, corporations, and so on. It doesn't go outside of that boundary. So huge lot of people in the world are rejected from that system. And Africa is particularly one where hardly that finance gets to the real people. So we created an alternative system called microfinance banking, geared to address that issue and reach out to the people who are not included into the other system. Its particular aspect of this is it doesn't have any collateral requirement, so that the wall that was created between people who can offer collateral and people who cannot offer collateral, that is removed because collateral requirement is done with. So it works very nicely, and it can be provided where you live. You don't have to come to the city to find it. The basic feature of microfinance is people should not come to the bank. Bank should go to the people. And no matter how remote you are, it's the responsibility of the system to reach out to you. With the introduction of telecommunication, with the mobile phones, it becomes much more easier now. There's no excuse now why anybody should be refused from financial system. So that's the challenge that we have right now.
Now, Nigeria's microfinance industry has been going from crisis to crisis, and as a result, it's been largely ineffective to the huge informal sector that exists in this country. Now, how do you think that Nigeria can get the microfinance equation right, and what model do you think we need to adopt?
Well, there are many examples available in the world. It's a question of choosing what you're looking for. If you're reaching out to the poorest people, women around, and villages after villages, there are examples available. Grameen Bank, the very name says village bank. So we work in the village, we don't work in the urban area. So that example is already available. And we work with the poorest people, loan size starting somewhere in $30, $50, averaging about $200. So you know what kind of clientele you have in that. And also the ownership model in Grameen Bank, the owners are the borrowers. So even if you're making profit, profit goes back to them. So a mission-driven banking.
What do you think we need to change in terms of policy?
If you want, you can make it a part of the regulatory thing. So if you call it a microcredit bank, for example, this is what you should do. Owners will not take any profit out of this. They are doing it as social business. It's a non-loss, non-dividend company, which we call a social business. So only then you can give you a license. Otherwise, why should you give a license to do banking? If you want to call it something else, you want to make money, you come to another door. But this door, what we call microfinance, is a door available only for people who are mission-driven job, mission-driven activity. Then everything will fall into that place. You can talk about a cap for interest rate, because here, if you are helping poor people, this should not exceed this. And if you can't do that, that means you're not interested, or your efficiency level is not that good. So you should do something else. So you should isolate it. So the regulatory design should be into it. Even you can make a legal framework. So microcredit or microfinance banking law. Law will decide how this will be done, what will be the equity requirement, in the spirit of all you're trying to do is to help people.